Welcome everybody to Rosecut's third quarter update. I'm joined by Mike. How's it going, Mike?
Dan, hi. Good to chat to you. Yeah.
Yep, we've got some interesting topics to talk about in markets. I'll just do the quick risk warning, mentioning that nothing we mention here is financial advice. Please reach out and speak to one of our advisors before doing anything. In terms of markets, one subject that we mentioned last time was the oil price and how the year-on-year comparisons have been helping inflation come back down towards the Fed's target. We've seen a bit of a reversal in the oil price, as we flagged was a risk last time around. How much of an impact do you think this is going to have on headline inflation numbers, Mike, and what the Fed might do from here and other central banks?
So I think it does two things, Dan, and bear in mind as well, a lot of other soft commodities, orange juice, olive oil, etc., have been rallying as well as oil. And it does two things. One, it will eventually push up the headline inflation numbers, and secondly, I think it will convince central bankers of the view that inflation is not dead. Which I think logically means that they need to keep rates higher, even raise them more, just to try and kill off some of these price pressures. So I think it means higher for longer on the rates front. And of course, the oil price itself, as you know and you've noted, is undercut by lots of different, probably geopolitical factors. We've had production cuts. Saudi Arabia politically moving away from the States, and then of course the US, their strategic petroleum reserve is now really getting down to the bottom of the barrel, as it were.
I quite like that pun. Very appropriate. One country where the inflation numbers are really starting to have an impact on their currency is Japan. And this is one of the things that was really moving last October, back when we had the gilts crisis and the pension issues. We had exactly the same conditions, with the dollar against the Japanese yen touching 150. The Japanese central bank may do some sort of FX intervention to try and bring this down, but it adds to the pressure on other currency markets, such as the UK as well. And one thing we notice is when Japanese government bond yields go up, they tend to drag up bond yields around the world, so including gilt yields and US Treasury yields, even German government bond yields, which are now hitting those highs. Now, we were talking just before we started recording, Mike, and we were saying the German bond, the 10-year bond at 2.8%, it benefits from not issuing as many bonds. The government's not trying to borrow as much money as the US and the UK, and that's why it stays at a lower level. But it's still a warning sign, and when the risk-free rate is actually getting quite attractive, then that it makes equities less attractive on a relative basis.
That's true, Dan. I think this is, writ large across markets now, is that investors have they've got cash as an alternative, they've got government bonds as an alternative to risky assets. And I think, just to go back to your point on Japan, the Japanese long bond yield is sort of the lower anchor on the bond market. So when that moves up, it tends to push yields higher. We've seen that across the board. And what we haven't really seen is kind of a real pickup in bond market volatility or in currency volatility. We're beginning to see it. But my experience is that you need to see that moment of volatility before either you get intervention by the Bank of Japan, or you get a sort of mini crisis somewhere else. Recall the gilts crisis last year.
Now, to add some balance to the argument around bond yields and inflation, there are some reasons why inflation could start to come back down and bring bond yields back down with it, which is the reverse of what we've just been talking about. Potential reasons include the central banks have now raised rates to the point where they're almost at the level that the Taylor rule would imply they should be at. And for those that are not aware, the Taylor rule is a formula that you could use for setting interest rates. It's historically been a sort of level that you needed interest rates to get to really stop inflation in a sustainable manner. So we're kind of getting to that point. And then, as for those that are watching on video, we've got on screen a chart of US consumer excess savings. And basically, during the pandemic, everybody built up their savings, and now, as times have got a bit tougher, they've drawn them down. And this is going to impact on how much people can spend. And it's going to happen just as student loans start to kick in again in the US, which was suspended. So a bit of a headwind for the US consumer.
It is indeed, and we're at. I think Europe is a guide as well. So if you look across the European economy, particularly Germany and France and Sweden, lending is falling off a cliff. Mortgage activity is dropping sharply, and consumer spending is beginning to tail off, even though unemployment rates are very, very low. We have the same thing in the States, where people are still in work, but household balance sheets have been eroded in the last year or so, and that points, I think, to maybe the next 1 or 2 years as being one where consumers will try and replenish their balance sheets, and we're probably going to get quite sluggish consumer spending. Difficult one, given everything we've said so far about inflation for central bankers, because on one hand they're confronted by high and rising headline inflation rates, and then within economies you're seeing the underlying pillars of the economy, like the consumer, begin to weaken.
So overall, it's not the best mix for taking a lot of risk within portfolios, which is why we remain quite cautious in our positioning. And I thought it was useful to give people a reminder that within a portfolio, you don't just have to hold equities to get a return. I've got 2 examples on screen here, which are relevant to the sterling portfolios, and it's a similar story in the dollar portfolios as well. You can now buy short-dated UK government bonds, so gilts, and take very little interest rate risk, which is your duration number. That's quite a low number. And the yield to maturity is essentially your capital gain and income return, so combined into a sort of total return metric. And if you're picking up 4.5% on short-dated government bonds, and you can even move out into high-quality corporate bonds that are also short-dated and pick up 6%, actually that's quite a decent return. In fact, it's better than the return you would have gotten certain balanced risk portfolios if you look back over the last 10 years. So actually, although it might sound like we're a bit negative on assets, it's not all assets. Like bond yields rising mean your expected return has gone up, and they look more attractive than they have, frankly, for the last 15 years.
I agree, and I think, Dan, one of the problems that many investors are mentally, they're in a world where maybe of the last 5 or 10 years where cash and bonds were not interesting and a lot of money was pushed into equities. We're in a much more balanced investment climate now, where lower risk assets, good quality corporate bonds, even cash, have actually got a decent return. And I think over the next year we will probably see some of more money, more flows come out of equities into fixed income.
So that's why we're defensively positioned. I want to finish off by just mentioning an asset which tends to get strong opinions, and that is, of course, Bitcoin. And the reason I want to mention this is because every 4 years there seems to be a cycle where for 1 year everybody gets really positive on it, and then it crashes, everyone forgets about it for 2 years, and then it starts again. And we're coming up to what's called the halving event, which is basically where the Bitcoin miners that secure the network, they get paid half as many Bitcoins for every block they process. That happens every 4 years. It's going to happen, I think, April 2024. And it often acts as a bit of a catalyst for price to start moving higher. And when prices move higher, the narrative starts to follow and people start to invent reasons to be bullish. And The other thing that's potentially happening in the next 6 months is potential approval of a spot Bitcoin ETF. So instead of one based on futures, this would be an ETF that would actually go out and buy Bitcoin. And we think this is possible because Grayscale won a court case against the Securities Exchange Commission in the US. They've been preventing Grayscale from launching an ETF. And BlackRock are also trying to launch a Bitcoin ETF, and they have a good track record of getting ETFs approved. So if you just consider what will happen if they do get such an approval, how much money could potentially go into space, and what sort of marketing efforts could be made by those companies, it's interesting. Like, I could see the cycle repeating itself.
Yeah, I do think this is very interesting. I think Bitcoin is interesting. It hasn't really moved while we've seen volatility in other asset classes. It's an ecosystem that has delevered about a year ago. And I think if you get ETF approval in the States, what that effectively is saying to retail investors and the big institutions is that Bitcoin is I don't think it's a money, but that it's an asset that people can invest in, and they would be given the mechanisms, i.e. the ETF, to invest in it. And I think you will see a lot of flows into Bitcoin crypto assets as a result of that. So I think it's quite interesting in terms of its evolution as an asset class at the moment.
Agreed. And it was the reason why I remembered to do it this morning right at the start of this podcast, just because it does remain a very volatile asset which you don't want to allocate too much to, if anything. But there's no point in just talking about it when the price has moved a lot higher. It's more interesting to talk about these things before they potentially happen. So I think we've done that today.
Yep.
Mike?
Lot to chat about.
Yep. Great to speak as ever. Look forward to chatting next time.
Thanks, Dan.